Good evening, participants. Welcome to today's webinar on Market Insight for Fixed Income by UTI Mutual Fund, where we discuss key updates related to bond markets, economy, and our outlook. I am Sonal Mittal, Product Specialist at UTI and your host for today's webinar. And I'm joined by our Head of Fixed Income, Mr. Anurag Mittal, to share insights, perspectives on bond markets. RBI policy concluded yesterday wherein MPC retained the policy rate. However, there was change in the stance to neutral. Also, last month, there was a surprise stimulus announcement by People's Bank of China that influenced the bond market. To discuss more and in detail, I will now hand over to Anurag. Over to you, Anurag.
Thanks, Sonal. Good day, everyone, and welcome to UTI Fixed Income webinar for the month of September. Well, September was a very eventful month. We had finally the rate cuts by the Federal Reserve as well, which had been waited for the last at least 12 months. We had the announcement of Chinese stimulus, which also led to reasonable move in commodity prices. And we also had the October MPC yesterday, which was the first meeting of the newly constituted MPC. To recall, the three external members' term had expired by August, and we had new MPC when the new external members were announced. So we'll start with the presentation. So first we'll discuss the global trends, and then we will discuss the MPC and what it means for investors. So if we look at the JP Morgan global PMI, both for manufacturing and services on the left-hand side, the trend has been quite consistent for a while now. Manufacturing has been in contraction, led by the advanced economies, as most of the supply chain issues are now normalized, and there has been a sector rotation from manufacturing to services, which has been in the continuation since 2023. So services continue to be in the expansion zone. It's moderating, but no major trend of moderation, still above 50, which indicates expansion, while manufacturing continues to be in contraction. If we look at a chart on the right-hand side, which depicts industrial production, as we can see, most of the decline in manufacturing is coming from advanced economies, while emerging economies continue to be quite stable. We do expect this trend to continue. If you look at the shape of the consumer market in the advanced economies, it's quite strong. If you look at the labor market in the advanced economies, it continues to be quite stable in both employment as well as in terms of wage growth. And hence we expect consumption to remain stable. We expect services to remain stable, and we expect global economy to continue to show positive growth. Moving on to the next slide, we talked about Chinese stimulus, which had been a major driver of currency as well as bond market. While China, has been trying to stimulate its economy for the last 3 years, and they have been announcing measures across the financial sector, the bond market, the equity market, as well as the real estate market. This time, the market participants took it quite seriously, because this was a time where there was a coordinated stimulus from the National Financial Regulatory Authority, which is the NFRA, from the China Securities Commission, as well as from the PBOC. So all these stimulus announcements that we saw in September, between 24th to 26th September, were well coordinated and were accompanied by media statements, and there was also a promise of further stimulus going down as well. So the market participants took a strong notice of it. And if you look at the various measures announced, they were across monetary, fiscal, banking, property, as well as equity markets. So just to start with the monetary announcements, there was a 20 basis policy rate cut. So China calls its policy rate as open market operation. So effectively, that's a policy rate cut, which they did of 20 basis points. They also have this medium-term lending facility, in which the central bank lends to the commercial banks for 1 year, which in turn influences the loan rate of the commercial banks. So as we can see in the slide, there was a 30 basis cut on the medium term lending facility. There was also a cut of 50 basis on the reserve requirements, which provides about 1 trillion RMB long-term liquidity to the banking system. So it's largely equivalent of our CRR. On the fiscal side, China has been grappling with weaker consumption, and hence, there was some announcements at a local level of additional, fiscal expenditure. The details are still sketchy. The government has indicated that it will give more explicit fiscal announcements probably at the end of October and November. So the market participants will be waiting for that. But at least for the first time in the recent history, the Chinese government announced cash handouts. So far, they have resisted handouts even for the poor. They focused on infrastructure creation, job creation, etc. But this was the first time where they announced, cash handouts for the very first time. So which also makes it that they are taking these stimulus measures quite seriously. And if you look at the real estate, where majority of household savings are invested, they had taken some tightening measures in the last 10 years, which they had been relaxing in the last 2 years. And so the current stimulus measures were a continuation of that. So as we can see, they have even cut the down payment requirement for second home for home buyers, so that to boost household spending. If you look at the funding cost as well, there was a re-lending announcement in which the local governments had option to buy property directly from the real estate developers and convert it into affordable housing. So earlier there was a ratio of 60-40, which now they have made it 100%. So there's a 100% direct funding from the central government to local governments to buy properties from real estate developers and convert it into affordable housing. Of course, there was also a announcement that on an average there will be interest rate cuts on the mortgage rates by up to 50 basis points. So depending on the tenors, depending on the whether the loan is fixed or floating, but there will be interest rate reductions to improve housing affordability. There was also a potential plan to announce that by which the banks will be able to buy land from the builders to give some benefit to the builders, to give them more liquidity, and in future create more real estate. Also, they in 2022 they had announced 16 measures, different micro level measures for home buyers as well as for real estate developers, which were expiring in 2024. So they have extended those 16 point measure program on real estate till 2026 to continue to provide support to the real estate sector. On the equity market, they have announced a 500 billion RMB liquidity provision program for non-bank financial institutions to borrow money from PBOC with collateral and invest money in equity market. They've also announced a 300 billion RMB re-lending program for banks to support listed companies, share buybacks again to support equity markets. So yes, these measures were taken quite seriously by the market participants. And what really changes after this? So if we would recall, the Chinese government had announced a 5% GDP growth target for calendar year 2024. If we look at the current trends, the actual growth was way below the 5% target. So probably these measures in the near term, if continued, should help get growth closer to 5%. Actual growth may still not touch the 5% mark, but it will nevertheless help growth register somewhere near about. But more importantly, what it really signifies to the market that for the last 3 years, the Chinese government had been focusing on sustainable growth. So whether it was, if you look at the cancellation of IPO of Alibaba or action on, various real estate developers or action on edtech, overall, the Chinese government had been focusing on sustainable growth. If we look at all these measures, these indicate that the Chinese government once again, just like in 2008, just like in 2013, they want to focus again back to boosting growth. And at this point of time, they want to boost growth from consumption uh, rather than infrastructure, which could be long-term positive. But we believe that market participants would need to see more details coming up, more rate cuts coming up, especially fiscal support coming up to boost consumption. As we know, Chinese household savings are in excess of 35% of GDP. So interest rate cuts have a limited impact on long-term and medium-term growth drivers for China. There's the fiscal stimulus, which should help boost consumption in the near to medium term. So whether these measures are sustainable and more durable on growth will be seen whether China is able to announce more fiscal measures to support further growth outlook. Moving on, if we look at the impact on how those measures have had on commodity prices. So if we see on the left hand side, the Bloomberg Commodity Index, for most period of the September, commodities, whether you look at oil or any industrial metals, they were quite stable and in fact subdued because of weak growth concerns. But what we saw at the end of September, after the announcement of these Chinese stimulus measures, commodity prices rebounded. If you look at industrial metals, if you look at gold, if you look at oil, all of them, of course, oil was also supported by escalated tensions in the Middle East between now Israel and Iran. And of course, that led to crude prices going all the way up to $80. But largely, both due to geopolitical escalations and measures of China, we saw impact on commodity prices. Mind you, the index is still on the lower side. It's still lower than the high that we saw in 2024. So it doesn't really materially impact inflation outlook for India. But nevertheless, we need to watch out that how this commodities prices pan out in the next couple of quarters to see the impact on core inflation, because these muted commodity prices were helping keep manufactured good prices lower, core inflation lower for India. So this is something which we have to watch out for. If we look at on the right hand side, which is the food price index, the FAO food percentage YOY, while it's almost negative, but it has picked up quite meaningfully in the last 6 months. The reasons being there were disruption risk due to Hurricane Helene in the US and drought conditions in Brazil, which is a key agri-commodity producer, especially on wheat and sugar. So there was a secular increase in prices on wheat, sugar, as well as on oil seeds, which led to food price going up. On the positive side, India announced the resumption of the rice exports, which shows that India is quite comfortable with rice production this year, thanks to a normal monsoon, which also is bringing down overall aggregate food prices lower. So overall, yes, we are seeing uptick in some food prices, but nothing alarming for now. So still we believe that food prices and overall inflation should remain well contained going forward as well. Moving on, if we look at the inflation path, and if we look where we were in terms of inflation peak for most of the major economies, so barring Japan, most of the major economies are now almost at their pre-pandemic inflation rate. So whether you look at US, UK, Eurozone, Canada, most of them are now touching 2%. And if you look at the breakup or the internals of these inflation drivers, as we saw in the first slide as well, is the manufacturing prices which are going down, which are in the deflation or disinflation territory, whereas services prices are continuing to hold up because of overall strong consumption. So we do expect service price, at least in the near term, to continue to be stable rather than moderate quite aggressively. So we think that these inflation levels should hold up largely on base effects. We believe that inflation prices should continue to slow down and move closer to 2%. But given that service inflation continues still to be slightly on the higher side, we expect monetary easing to be slightly gradual. So this cycle is slightly different than previous monetary easing cycles globally that we have seen. Typically, we see aggressive rate hikes, and then periods of slowdown, we see aggressive rate cuts as well. If we look at this cycle, given that inflation is still quite moderate, it's moderating very slowly. Even the rate cut cycle will be more patient. It will be more gradual, where central banks will continue to be data dependent. They will look at every data on inflation growth dynamic, and then they will cut rates. So yes, the journey will be slightly slower, but what matters is that the end point of the terminal interest rate. So we still believe that the terminal interest rates uh, have some reasonable space to go down, especially in the advanced economies. Moving on. So what gives us this confidence that there is still a decent scope for interest rates to go down? So in September we had the FOMC meeting. What we saw in the FOMC meeting was one, the Fed board mark to market their employment forecast. As we can see, from 4% projected in June, they are now projecting a 4.4% unemployment rate in the fourth quarter of 2024. From a 4.2% projection, they are now projecting 4.4%, and from 4.1% in June, they are projecting now a 4.3% unemployment for fourth quarter of 2026. If we look at their real GDP forecast, that's largely unchanged, apart from a very modest decline in 2024. So from a 2.1% forecast, now they're projecting a 2%, but the rest of it is unchanged. But if you look at the core inflation as well, now they're projecting, in a 0.2% decline in 2024 and a 0.1% decline in 2025. So it's almost reaching close to 2% target. But the more important thing which we have to look is the Fed fund target, which they have given in 2024 and 25. So compared to 5.1, which barely implied a 50 basis rate cut, now they're projecting a 4.4% by end of 2024, which largely implies a 100 basis rate cut during 2024. And if you look at 2025, they are projecting about 3.4. So again, almost 100 basis cut, in 2025 as well. So yes, they started the rate cut cycle with a 50 basis, but if we look at the dot plot, it suggests a gradual path of rate cuts going forward. The Fed, although they started with 50 basis, but they were slightly circumspect and tentative. Chairman Powell called it largely a insurance rate cut, as the economy is slowing. Unemployment is rising, although the last print was quite strong. But broadly, they started that given the distance that they have to cover. So if you look at how much of rate cuts they're expecting almost a 200 basis rate cuts in next 2 years. So if they have to do a 200 basis rate cuts incrementally, they thought that they can start with 50, and then they can look at data as it comes along to decide on incremental course of action. More importantly, they don't still view the economy as very weak. So Fed chair characterized labor markets in solid shape with a very healthy unemployment rate and conditions close to maximum employment. So if you just like we said, if you look at their forecast on real GDP, that's not changed materially. So they're still looking growth at quite reasonably high, and hence we believe that they will be more gradual in their rate cutting cycle. Although they have started with 50, unless and until the data sharply deteriorates, we think that they will be cutting in the sequence of 25 basis and beyond. And that's what brings us to largely, if you look at how globally market saw the interest rate cuts. If you look at the market reaction, it was quite modest. So despite a 50 basis cut and expectations of further rate cuts, the 10-year was stabilizing in the range of 3.78. So just a change of 12 basis. Whereas if you look at the 10-year sovereign bond yield in the US, where it was about 4.7% in April. Uh, about, I would say, 80 basis of move was made even before the rate cut. So largely, market had discounted, the rate cuts, and once the Federal Reserve gave a more gradual path, the further decline in yields has been quite on the moderate side. Moving on, if you look at the market implied rate forecast on the right hand side, which is the orange chart, markets are now pricing 150 basis of aggregate rate cuts by May 25. So if you look at the number of policies from now to May 25, there are 5. So at least market is pricing that at least in one policy, Fed will be doing a 50 basis rate cut. So the growth conditions, like we said, have to sufficiently deteriorate from current levels for Fed to do a more aggressive rate cut. But if Fed continues on the path that they have forecasted in the dot plot, probably Fed's path is slightly less aggressive than what market is implying right now. So they are expecting growth to be slightly stronger than the market. And hence they're expecting inflation to moderate to close to 2 and not really go below 2%. So yes, it's for advanced economies, it's a reasonably, I would say, aggressive rate cut cycle, but it's still a very, gradual rate cut cycle. Moving on to, domestic markets. So yesterday we had the MPC, and overall, the expectations from the market participants had changed recently in the last 15 days from the MPC. So at least, till 15 days back, the market participants were expecting, RBI to at least change their stance to neutral, and even some market participants were expecting even outside chance of a rate cut in the October policy because of overall slowdown in global growth dynamics and a 50 basis rate cut from the Fed. What really changed in the last 15 days, what we talked about was one, the geopolitical escalation between Israel and Iran, which led crude prices to go to $80, and there was also a risk of crude prices further breaching $80. There was also the Chinese stimulus, which led to jump in commodity prices and overall changed global growth outlook. So the market participants approached the MPC with very muted expectations. If we would recall, the 10-year GSEC, which had touched a low of 6.71%, almost went to 6.85% because of the change in market participants' expectations from the RBI. So they went with a muted expectation that probably RBI will not do anything. RBI will wait for all these factors to play out and then probably take some action in the December policy. But the MPC changed the stance to neutral from withdrawal of accommodation. We believe it reflects their confidence on inflation. If you look at their Brent price forecast, they're forecasting that Brent probably for the next 6 months will also remain around $80 per barrel, which is close to the current level, as they expect global growth and global demand for oil to be slightly muted. The second thing which gives them confidence is a very favorable monsoon. As we know, monsoon has been higher than the long period average, and that's resulted in higher kharif sowing as well as expectations of food grain production. We will discuss that later, but broadly, what RBI is really confident on that given a favorable monsoon, although the next couple of prints on inflation will be higher than 5% because of base effect and because of unseasonal rains and vegetable prices seeing some shock, largely they expect inflation to remain moderate. They expect food price inflation to come down. And why food is very important? Because if you look at inflation X of vegetables, if you look at inflation X of food, is in fact, inflation X of vegetables is close to 3%. Inflation X of food, as or core inflation, has been around 3.5%. So it's actually the food inflation for the last 6 to 9 months, which has been playing the spoil sport, which has been keeping overall inflation quite high, and hence RBI had to be in the withdrawal of accommodation mode to ensure that the inflation expectations are well anchored. So yes, now they are much more confident of inflation, and that's why we are seeing the change of stance, which we view it as quite positive. They are continuing to be optimistic about growth. If you see, look at the growth forecast. Uh, they're still projecting 7.2% for FY25. They are, in fact, they have upped their growth forecast of 7.32 from 7.2% from the previous policy, probably to account for lower growth in the first quarter this year because of elections. So probably, but that's understandable. But we think that given the slowing consumption, especially on the urban side, if you look at the GST, collection, if you look at the four-wheeler sales, if you look at the core sector output, probably the actual growth numbers could be slightly lower than what RBI is projecting right now, which opens up the space for rate cuts in the upcoming policies going ahead. So barring a commodity price shock, which leads crude to go much higher than current levels, or other commodities with changes forecast from core inflation, we think that the fact that RBI could change the stance of the current policy despite a very volatile backdrop globally. We think that RBI is quite confident on inflation, and also there is probably an implicit acknowledgement that yes, growth is under some risk. So if you even look at the RBI policy yesterday, the governor also acknowledged that the downside risk on growth are increasing because of this global financial market volatility, because of this geopolitical tensions, which could lead to slowdown in global trade, and hence probably we think it's a combination of slowing inflation as well as slowing growth. So of course, by the next policy, if growth continues to be at 7% plus and inflation continues to be at 5%, probably RBI may wait out. But yes, if growth is slightly lower than 7, inflation is moderating, Rabi sowing is healthy, probably RBI could cut rates starting from December itself, or they may push back to February if commodity prices are on the higher side. But we think more importantly, investors should now look at the totality of rate cuts that can be expected in the current monetary policy cycle. So for all the investors who are looking for RBI to pivot, they have pivoted, at least in terms of stance. It is expected that they will also start to cut rates once the hard evidence of inflation is also seen of declining. Moving on. So like we were discussing on inflation, largely inflation for the month of August came at 3.65, with the benefit of base effect. But if you look at the CPI diffusion index on the right hand side, and if you look at the total percentage of constituents which were higher than 5%, we can see that they're continuing to decline. They're close to 25%, and which broadly means that 75% of inflation constituent is actually lower than 5%, and it's pointing towards moderating inflation going ahead. If we see in the inflation forecast, RBI has projected a 4.8% inflation for Q3 FY25, probably because of unseasonal rains, which has led to some disruption in vegetable supply, and hence we've seen on a real-time basis vegetable prices are increasing. So probably the next two inflation prints will be slightly over 5%, in fact, but from December onwards, inflation should start to subside. Moving on. So we were discussing monsoon, and was given confidence to RBI to change their stance. As we can see, for all India basis, the distribution of monsoon was 5% higher than long period average, so it was actually a surplus monsoon. If you look at the distribution as well, apart from northeast and eastern part of the country, most of the regions saw normal or above normal rainfall. If you look at the 36 subdivisions in which India is divided, 31 out of 36 divisions experienced normal or above normal cumulative rainfall. And if you look at the the output, sowing has been quite healthy. Whether you look at rice, pulses, oil seeds, sowing has been quite healthy for most of the crops, which overall bodes well for food inflation going forward. This also has resulted in reservoirs being at 87% of their capacity, which is almost 10% higher than uh, you know last year and 17% higher than long period average, which also is quite helpful for Rabi sowing as well. So both for Kharif sowing, which Kharif production, which is your summer crops, and Rabi, which is your winter crops, it is healthy, and it gives great confidence to RBI that probably inflation, uh, which has been affected because of high food prices, should moderate in the near term. The second half borrowing calendar was announced in September. And as we can see, if you look at the belly of the curve, which is 6 to 15 years, that was slightly reduced. And most of the increase that we saw compared to the H1, which we see in the up to 5 years, and some increase was seen in the 15 plus on the long end of the yield curve. We think it's quite positive for us steepening view. So if you had been listening to our webinars, we had been of the view that probably as we get closer to the rate cut cycle, the curve should steepen. It had not been steepening because the distribution of the borrowing curve was slightly more tilted towards the belly or the 16 to 6 to 15 segment. If we see the current distribution of the borrowing, it is actually quite balanced, and slightly, in fact, the borrowing in the 15 plus year segment has been increased. So if you look at the 2H borrowing of FY23, FY24, and if you compare it to FY25, the long end borrowing has increased. So while yes, in periods of rate cuts, the mark to market on long end could be slightly higher, but from a risk reward perspective, from a valuation perspective, is the 5 to 10 year space, which looks quite healthy and looks much more controlled. Moving on, if you look at from the liquidity perspective as well, so liquidity, because of government spending, it reverted to surplus. It had remained in surplus for most of the quarter, for July, August, and beginning of the September. Because of advanced tax flows, it had moved to deficit for a while, but again, it reverted to surplus by month end. We expect liquidity conditions to remain comfortable. In fact, the change of stance now allows RBI to intervene quite actively and more decisively for liquidity management measures to ensure that overnight rates stay close to the policy rate. And in fact, this is quite supportive for the money market rates as well. If you look at the credit deposit growth, and if we compare to the beginning of the year, if we look at this orange line with the blue line, which is the deposit growth, and orange line, which is the credit growth, and as we can see, the gap between your non-food credit and your deposit growth is moderating. So banks have been quite aggressive on raising deposits. They have been quite active there, thanks to the directions from the RBI, and also because of various risk measures being announced. Your unsecured lending and retail lending has also seen some downtick. So if we see, retail loan growth has softened slightly from 17.8% in July to 16.9%. And if you look at unsecured loan growth, that's falling quite sharply from 15.6 to 14.3. So as a result of RBI's measures and RBI's directions on both on the deposit side as well as on the credit growth side, that probably unsecured lending needs to be moderated. Probably banks need to focus more on the secured lending part. Probably they also need to focus on their ALM part and ensure that they raise good quality retail, granular deposits. That's also resulted in deposit growth also picking up quite sharply. This, from an investor perspective, this is quite important. That also means that the CD issuance because of which, high credit growth on which banks were quite aggressive on, probably that should moderate in coming months and quarters, and that also bodes well for investors who are looking to diversify away from liquid funds. Probably they're looking at money market, ultra short, low duration funds. uh, because once your CD issuance moderates, so the current spread that we are seeing between 3 months to 1 year, or overnight to 1 year CD, 6 months CD, that should also compress in the upcoming months, thanks to the moderating in credit. If you look at the fiscal trends are quite healthy, thanks to lower spending, especially on the capital side, as we can see on the bottom chart, or the bottom table. Sorry, there was a 30% YoY reduction in capital expenditure. So as the new government got formed in June, it's still taking some time for government to release funds for all the capital expenditure related projects, and hence we are still seeing some slowdown in spending. And as a result of which, if you look at the fiscal deficit, which was just 27% of FY25, budgetary estimate, which is the lowest in 2 decades. If you look at the revenue collection, while your corporate tax and GST is moderating, your income tax, especially supported by capital gains, thanks to buoyant capital equity market, has been quite healthy, and your income tax has been offsetting the decline in corporation and GST. So the run rate required in corporation tax and GST is slightly increased, but we believe that thanks to personal income tax, government should be able to meet its revenue targets going ahead as well. So on the balance of payment, nothing alarming to see. As we can see, largely it's been in the range of 1.1%. Yes, there was a expected decline from 0.5% of GDP in Q4 FY24 to 1.1% in Q1 of FY25. We had a seasonal pickup in merchandise trade deficit as well. So as we can see, the merchandise trade deficit moved from $52 billion to $65 billion almost, largely driven by moderation in exports. So as you can see, there has been a global moderation in trade, and if you look at the total exports, they have moved from 121 billion to 111 billion. So that's also resulted in some decline in current account. If you look at invisibles as well, especially in income transfers, whilst because of increase in royalty payments from Indian corporates to their MNC counterparts, we've seen some decline in transfers. We have also seen service exports also now kind of flatlining in terms of growth. So overall, yes, it's I would say slightly declined from Q4, but overall balance of payments, even if it current account prints at 1.2% of GDP for the full year, it's quite healthy, quite manageable, thanks to overall robust capital flows and positive service export. On the trade deficit also, there was a very peculiar pickup in gold imports, as we can see in August 24, from 3 billion in July to almost 10 billion. The reason was the reduction in custom duty in gold in the budget in July, which led to gold imports picking up in August, as the prices went down for a while. But that was a temporary phenomenon. Now the whole effect has played out, and we expect trade deficit to be in the historical levels as we have been seeing for the previous months from April to July. So probably trade deficit should again come back to 25-26 billion on a monthly run rate. On the yield curve, as we can see, as we saw on the global trends slide as well, just like there was a decline in bond yields globally, there was also a decline in bond yields in India as well. Across the curve, as we can see, the biggest decline happened at the short end of the yield curve. If you look at 3 months, 6 months, 1, 2, 3 years as well, there was a decline of 12 to 15 basis. In the shorter end, it was about 20 basis points. As we get closer to the rate cut cycle, we should be continuing to see more decline on the short end compared to the long end. That typically plays out in every rate cut cycle, because Typically, short-term rates are more anchored to liquidity and near-term, like in the overnight policy rate. So as the policy rate gets reduced in the upcoming policies, probably short-term should continue to see more traction. This is largely what if we look at instrument-wise in terms of T-bill, AAA, GSEC, and AA rated yields. So as we can see in the month of September, we saw a secular decline in yields across the curve, as you know, on favorable global cues as well as expectations of rate cuts domestically. So largely to summarize our view, as we saw, the fiscal is quite strong, the lowest in 2 decades for the month of April to August. The borrowing calendar was unchanged. If we look at external account, the current account is quite healthy, even at a 1.2%. Given our FX reserves of 700 billion plus, there is no concern on the external account. So largely, the monetary policy has been held hostage due to a very high food inflation, which has kept headline CPI on the higher side. And thanks to strong monsoon, now food inflation is cooling. And hence, as global growth momentum continues to slow down, if food inflation continues to moderate down, that should open up the space for RBI to cut rates by 50 to 75 basis points. What kind of products make sense? We know that we have been recommending moderate duration products for a while now. But as you can see, the performance of moderate duration products, in the last 6 months, that has picked up as expectations of, rate cuts have also picked up. So moderate duration products, which typically run duration between 1 to 4 years, we believe are, provide the best risk reward in a period of shallow rate cut cycles. Like we said, that once we are only expecting 50 to 75 basis points. So if you look at the shape of the yield curve, which we saw in one of the previous slides, 2-3 year AAA bonds are still giving you a accrual of 7.5 and thereabouts. Whereas if you look at on the long end side, even a 30-year GSEC is, yielding somewhere about 690 to 95. So, from a risk reward perspective, and given that we are now closer to the rate cut cycle, we think more value has to be found in the 2 to 3 year AAA space, and hence we are recommending products like short-term fund, corporate bond fund, etc. for investors who are looking to invest more than 12 months. For investors who are looking at 6 to 12 months, we recommend them to consider allocation to money market and low duration strategies, because now the gap has opened up quite meaningfully. So if you look at overnight rate, which is 6.5, if you look at the 1 year CD, which is close to 7.5, there's a 100 basis gap. So the approval makes a strong case for investors who have some, tolerance for some mark-to-market volatility. Probably they can consider these strategies given the considerable gap and of course some expectations of rate cuts. So that's it from our side. Happy to take up questions. Thanks a lot, for joining the webinar. I would request Sonal to start taking investors' questions, and happy to answer the queries. Thank you.
Thank you, Anurag, for your insightful presentation and sharing outlook on fixed income markets. The webinar is now open for question and answers. You have already been provided a link. Please do share your questions on the link. While I wait for the other questions to queue up, let me begin with some of the questions that we have already received. The first question goes like, Anurag, what is your view on the demand for Indian government bonds and their yields following inclusion in FTSE Russell's index after earlier inclusion by JP Morgan and Bloomberg? Also, which part of the curve will be benefited with this inclusion?
Right. So that's a very important point, Sonal. Thanks for asking that. So FTSE Russell, included India in its latest review in the month of October. And as a result of that, FTSE Russell has included India in the emerging market government bond index. So the data on the AUM tracking the emerging market government bond index is slightly still, I would say, quite muddy. But market expectations is that it should be about 40 to 50 billion. So assuming that India will get a weight of 9.9%, sorry, close to 9.1%, we expect India to have uh, or to experience a flow of 4 to 5 billion, um, assuming the passive investors decide to fully replicate the benchmark. But more importantly, it's the index inclusion is happening from the month of September 2025. So it's still some time away. So probably we expect those flows to come, close to the index inclusion date, and hence we do not really see an immediate impact as far as the flows are concerned. But given that now India is included in the JP Morgan, emerging market bond index. India is now included in the Bloomberg emerging market bond index, as well as now FTSE Russell emerging market bond index. This overall, paves the way for India to even enter into other aggregate global indices, which can have a meaningful impact on flows to India. Also, it also puts Indian bonds on the radar of many foreign investors who are not looking at India as an emerging market, from a debt perspective. I mean, of course, they were looking at India from an equity perspective, but India was not really seen very seriously from a debt perspective so far. But I think with inclusion of India in all these indices, now foreign investors are looking at India very seriously. One of the benefits of India is of also, apart from our, a very strong fiscal consolidation roadmap, is also our FX reserves of 700 billion, which is keeping our currency quite, stable, and which foreign investors typically tend to prefer. So they typically tend to prefer in stable and lower volatile currency. So I think even the investors who are looking at funds actively, even active investors, could possibly now looking at India and its overall, quite positive for demand supply in the medium term. As far as which part of the yield curve is, the most attractive, totally depends on one's investment horizon. So if one is looking at a more medium term view, which is, let's say, more than 12 months plus, investors should be allocating to, let's say, moderate duration funds, which are giving them reasonable duration between 3 to 4 year AAA part of the yield curve. If investors have a more than 3 year plus kind of investment horizon, then they can consider gilt funds and long duration funds, which typically carry slightly more aggressive duration. But of course, they come with slightly higher volatility as well. But given that we are in the, just starting with the interest rate cut cycle, probably investors who have a slightly longer term horizon can consider allocation to these strategies as well.
Thank you, Anurag. My next question goes like, given easing inflationary pressures, market participants perceive the shift to a neutral stance as a precursor to a rate cut and broad tolerance of surplus liquidity conditions by RBI. What are your views on this?
So we also agree with the assessment, and that's what how our portfolios are positioned. Like we said during the presentation, RBI has done rate cuts along with stance change in the past. So RBI could have very well not changed the stance in the October policy. They could have done it with the next rate cut whenever they wanted to do that. If you remember, RBI's press conference post policy, they called the stance change as buying optionality, which is almost equivalent of buying a refundable airline ticket. So in case our plan is not very fixed, we tend to buy a ticket, and it's slightly at a higher cost, but we can cancel if our plan is changes. So similarly, what we believe is RBI is also more confident on declining inflation. They're also slightly probably concerned on how global growth could pan out, and that's why they bought this optionality that they have changed stance. So in case they decide to cut interest rates in December or February, it does not really come as a surprise to the market. And more importantly, like we discussed about how geopolitical escalations are happening, how various countries are also at one hand Fed is cutting interest rates, on the other hand China is increasing the stimulus, which is also leading to some commodity prices going up. It's leading to some capital outflows from India tactically. So what could also happen going forward is that RBI could be doing some FX interventions to ensure that rupee remains stable. And as RBI does FX intervention, it also in a way sucks out liquidity from the banking system when it does the FX intervention. So the neutral stance also allows the RBI to provide liquidity as and when needed, uh, to ensure that the liquidity remains positive, liquidity remains surplus, liquidity, and ensure that the actual operative rate is closer to the policy rate. So we agree with the market assessment that yes, stance change probably opens the door for rate cuts going ahead.
Sure. Thanks, Anurag. The next question is, what is your view on the longer end, above 5 years of the curve? Do you see it to hover around at the same level where it is, or will it decline further as we move closer to the rate cuts?
So it depends on the quantum of rate cuts that market participants are expecting. It depends on the kind of growth dynamics that play out. So in case so right now the expectations of the most of the market participants is, as far as India is concerned, we don't have a growth problem. We may see some moderation in growth from RBI's projection of 7.2%, but probably India will still be growing at 6.5% plus growth rate, considering the thrust on infrastructure by the government, considering a surplus monsoon, which should lead to better rural consumption going forward. But in case the slowdown is quite meaningful globally, which results in maybe even weaker exports than we are projecting right now, or it probably leads to some slowdown in commodity prices despite the China stimulus, and it leads to even lower inflation outturns than expected. Probably we can look at even more aggressive rate cuts, or at least in the near term, more aggressive market repricing of rate cuts, which may lead to outperformance of long-term bonds or longer end bonds compared to up to 5-year bonds. So but whenever we look to invest in these strategies, typically we are investing for, I would say, medium to long term. So we are investing for 12 months, or we are investing for at least we are looking at long duration kind of category. We are investing for 3-year plus kind of investment horizon. So we think that at least investors should not probably look at these things very from a tactical perspective. So these things will happen. Market will reprice continuously. As we were discussing the market pricing of Fed rate cuts. At one point of time, when the year started, market was pricing 150 basis rate cut. In June, market was pricing 50 basis rate cuts, and now market is once again back to repricing 150 basis of rate cuts. So market keeps on changing. Broadly, we have to look at long-term averages. We have to see what works in the long term and keep our asset allocation accordingly.
Sure. Thanks, Anurag. That was quite an insight for our viewers. The Indian economy is showing few incipient signs of fatigue in growth. Besides cyclical factors such as weather patterns and religious calendars, structural factors such as job creation and regulatory actions remain key headwinds. How do you perceive these concerns?
I think, I mean, in terms of consumption, we have done an analysis on weakening consumption as well. I think one of the key considerations for weakening consumption has been decline in disposable income, as well as effective personal income tax has gone up. So we saw the fiscal slide, right? Just some minutes back, where we saw that corporate tax is not really meeting the budgetary run rate. GST is not meeting the budgetary run rate, but the income tax is even higher than the budgetary estimate so far. So what's really happening, and that's our assessment, that we don't think that the government is spending less on rural India. In fact, the government is spending more if you look at it as a percentage of GDP. If you look at job creation or wage growth, I think from a trend level perspective, we are not really seeing a major decline uh, in job creation. In fact, we are seeing a steady growth in job creation. We think that probably it's the decline in disposable income as government wants to move towards fiscal consolidation, which is also a positive from macro perspective. But till government is in the path of fiscal consolidation, we will probably see uh, slightly higher effective taxes and probably slightly weaker disposable incomes, and that's why we are seeing urban consumption continuing to slow down in the near term. But I think from a more structural perspective, given that consumption is 60% of our GDP, and the way the government is been spending on infrastructure, if you look at the corporate balance sheets, they're very, very healthy. So we do expect private investment to pick up in the medium to long term, and we expect overall India's growth cycle to be quite constructive. And in fact, that's why it is in line with the rate cut. We are expecting a shallow rate cut cycle because we are not really expecting a major decline in India's growth drivers.
Okay. In the interest of the time, I will take two more questions. What is your view about foreign investors buying Indian debt in the second half of this fiscal year amid strong macroeconomic fundamentals with potential domestic rate cuts also boosting this appetite?
Sure. So we think that foreign investors. There are two kinds of investors. One are the active and one are the passive. So active investors is very difficult to determine which way they will go because they have the whole world at their disposal. So they can continue to invest in the US or they can invest whenever they find maximum value and depending on the mandate. As far as the passive investors are concerned, given the inclusion of India in Bloomberg as well as JP Morgan, and that's happening in a staggered manner. While about 15 billion already has come in Indian bonds, we do expect 10 to 15 billion can still come on the back of these index inclusions from the passive investors. So we still think there's still a decent demand which is yet to come on the passive side, given that RBI has removed 14-year and the 30-year GSEC from the fully accessible route. Most of this demand should come between the 5 to 10 years duration space.
Sure. The last question is, what is your view on crude oil? If the crude oil picks up because of geopolitical concerns, India's macros could take a hit. Your take on this?
So we think that as long as it's a controlled or a range bound increase, we really do not see any major impact on India's macro drivers. So if you look at where India has been really keeping its retail prices, right? So even when crude prices went to $70 in the month of August and September, Indian oil marketing companies did not really cut prices. So even if, let's say, oil prices were to trade uh, over 90 as well in the very short term, probably we think that OMCs have a reasonable buffer of profitability, and we really do not see any major impact on Indian inflation drivers. Of course, if crude were to go above $100, which probably would happen in a crisis situation, that is when Indian bond investors and RBI may start to get worried. But I think as long as crude prices remain between 75 to 90, I would, probably bond investors would be quite agnostic.
Thank you very much, Anurag. With this, we come closer to the end of our today's webinar. I would like to thank all our viewers for being part of this webinar and asking questions actively. Post concluding remarks from Anurag, we can end today's webinar. But I would request our viewers to share feedbacks on the link provided to you.
Thanks a lot, Sonal, and thanks a lot to all the viewers for joining in on our webinar. Hope you found the session useful. Please let us know in case of any feedback, in case of any queries, in case anything got missed out. Thanks a lot. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.